Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Thursday morning, October 22nd, 2015, and the title of this week's audio blog is A Match Made in Hell, Economic Collapse and Exponential Money Printing. First off, let's just get the good stuff out of the way. Incredibly, my beloved New York Mets, who I've rooted for through thick and mostly thin for my entire life, not only made it to the World Series for the first time in 15 years, and just the second time since last winning it 29 years ago, but they did so in the most convincing fashion imaginable. Back in June, this team was dead last in the majors in scoring runs, beset by its typical debilitating run of devastating injuries, bad contracts, and general offensive, and I do mean offensive, lethargy. However, the season turned on one of the wackiest imaginable scenarios, just one day following the team's ugliest, most heart-wrenching defeat of the year. To wit, in a situation epitomizing the negative impact social media can have on people's lives, shortstop Wilmer Flores was left in a game despite his being traded to Milwaukee being spread all over the internet. Flores, who had been with the Mets organization since the day he was drafted from his hometown in Venezuela 7 years ago, at the tender age of 17, visibly cried on the field until he was finally, mercifully, taken out of the game an inning later. Incredibly, the trade fell through the following morning, when the player he was to be traded for failed his physical. So Flores was granted a second life with the Mets. And what did he do with it? Only hit an extra inning walk-off home run the very next night against a key division rival in one of the most important games of the year. And better yet, instead of trading for Carlos Gomez, he of the failed physical, they, at the last second, literally minutes before the trade deadline a few days later, wound up trading lesser prospects to Detroit in return for former Cuban defector Yoenis Cespedes, who subsequently went on a late-season tear for the books, to the point that not only did the Mets lead the majors in offense in the past 2 months, but Cespedes is actually being considered the National League MVP award. As for Flores, he'll be the Mets' starting shortstop in the World Series, after the team's other shortstop, Ruben Tejada, had his leg broken by an ugly, vicious slide by longtime Mets nemesis Chase Utley, whose actions angered me so much I actually wrote an article about it the very next day titled Common Sense, Money Printing's Biggest Casualty. I encourage you to read it, especially the thousands of baseball fans amongst you. And as for what the Mets did to the Cubs, it was truly one for the ages, in sweeping them in 4 games on the back of a Babe Ruth-like home run barrage from the most unlikely of sources, i.e. the decidedly not home run hitter Daniel Murphy. And of course, the best young pitching staff in generations. Ironically, in what can only be viewed as quasi-proof that there is some kind of existential flow to the universe, the Mets completed the sweep, thus ending the Cubs' potentially curse-breaking series with a bang on Back to the Future Day, i.e. the very day, October 21st, 2015, that Marty McFly in the 1989 movie Back to the Future 2 got out of his time machine to the site of a billboard proclaiming, "Cubs finally win World Series," in a sweep. Finishing the point, I have no idea what will happen when the World Series starts next week, in either Kansas City or Toronto. Strange things happen in the world of sports, i.e. the ultimate reality show, and given what has occurred throughout the Mets' unlikely run to the pinnacle of the baseball world, it's very likely I'll be writing of still more incredible things 2 weeks hence when the Fall Classic ends, in either ecstasy or agony for Mets, Royals, and Blue Jays fans. Why'd I start with this decidedly not financial-related topic, you ask? Well, of course it's partly due to my excitement about the Mets, who claimed the National League pennant a mere 8 hours ago. However, it's also to demonstrate the relative randomness of everyday events, which can transform a situation entirely in the blink of an eye, such as the rags to riches stories of Wilmer Flores and Daniel Murphy, and the riches to rags stories of the Billy Goat cursed Cubs. Of course, when the World Series is over, the best team will truly have won, as in the American League, the Royals and Blue Jays had the 2 best records, and in the National, the Mets clearly have the best pitching, as well as the best hitting for more than 2 months now. Regarding the Cubs, who just a week ago were the odds-on favorite in Las Vegas to win the World Series, it just goes to show that hope and emotion don't win baseball games, as clearly the Cubs' glaring lack of experience and pitching depth was exposed immediately, and that, like the Federal Reserve's predictions of imminent rate hikes for the past year, even the so-called best and brightest can be, and in finance usually are, decidedly wrong. In other words, life imitates art, and nowhere more so than the completely erroneous beliefs of the so-called powers that be and their minions in Wall Street, Washington, and the mainstream media, who, despite their collective power, influence, and arsenal of analytic and manipulative tools, have been as wrong about the direction of the global economy, the influence of monetary policy, and the popularity of its schemes as could be imagined, as opposed to despised, loathed, alternative media commentators like the Miles Franklin blog, who for years have warned that such policies are not only highly likely to end in financial and economic tears, but for all intents and purposes are mathematically guaranteed to do so based on the cumulative experience of 2,000 years of economic history, and more specifically, the experience of nearly 1,000 years of fiat currency regimes, of which all 600 previous iterations failed, without exception. In today's case, it is the first time the entire world has been tethered to a fiat currency regime simultaneously, i.e., not a single currency is backed by anything more than the oxymoronically titled full faith and credit of their respective governments, or more appropriately, of the independently operated banker-owned central banks authorized to print them. Just look at the chart of any country since the gold standard was abandoned in 1971. Not just by the Nixon's United States, but all 44 participants in 1944's historic Bretton Woods Agreement, not one of whom protested when the U.S. reneged on its role as leader of the global monetary system. Mired in ignorance and salivating of the near-term boon anticipated from being handed an untapped credit stream, 44 central banks went on an epic borrowing and spending scheme unrivaled in history, which, as I write on Back to the Future Day, has put us in, per the title of an article I penned last week, the worst global economy of our lifetimes. Take a look at the chart of the debt and debt to GDP progression of any of the 44 Bretton Woods participants since 1971, and heck, the other lesser 140 nations that were unwittingly forced to join the money printing party by virtue of the force of the aforementioned 44 nations' will, and the carnage becomes painfully evident. The U.S., for example, had just $370 billion of debt in 1971, and after the equally oxymoronically titled debt ceiling is raised next week for the 75th time, that is, if political infighting doesn't cause the terrible debt accident Jack Lew warned of on Monday, the U.S. national debt will be nearly $19 trillion, or 51 times higher than in 1971 when the gold standard was abandoned. Not including, of course, the $5+ trillion of off-balance sheet debt owed by newly nationalized mortgage black holes Fannie Mae and Freddie Mac, and upwards of $200 trillion of unfunded liabilities resulting from 44 years of printing press-backed government promises. Which in today's dependency nation environment, in which the vast majority of middle-class breadwinning jobs have been lost, with more than half the population receiving some sort of government entitlement, will only grow exponentially in the coming years and decades, turbocharged by the same demographic hell, i.e. rapid aging of the population, being experienced in nearly the entire Western world. But don't worry, America's unwashed masses can read about how well the 1% that have received the Fed's, ECB's, and Bank of Japan's free money are doing, rigged markets and all, or simply turn on their TVs to see clips of yesterday's IPO offering of Ferrari, which emits record profits, went public yesterday, as an army of $100,000 cars were paraded down Wall Street. How's the real economy doing, you ask? Well, if the first 2 weeks of America's third quarter earnings season are any indication, which I assure you they decidedly are, my characterization of the worst global economy of our lifetimes cannot be more apt. And certainly the worst since the deer-in-headlights economic lows of both the post-9/11 and fall 2008 financial crises. For at least the third quarter in a row, year-over-year earnings comparisons are coming in negative. As always, vastly overestimated by Wall Street, just as the Chicago Fed National Economic Activity Index, which, as I write, published at a much less than expected negative 0.37. However, this time around, the earnings carnage has a decidedly uglier bent, as clearly the historic commodity crash I warned of a year ago in crashing oil prices portend unspeakable horrors, which, per January's direst prediction of all, may well continue for the next decade, is starting to catalyze massive capital expenditure cuts, layoffs, and dramatic forward-looking guidance reductions. And nowhere more so than at the nation's largest employers, which, per the Challenger Employment Survey, are on track to make 2015 the the worst year for corporate layoffs since, drumroll please, 2009. To wit, Lockheed Martin, by far the world's largest defense contractor, and by far the largest vendor of the Defense Department, America's largest employer, announced plans to cut corporate overhead costs by 30%, which for a company with a $40 billion annual cost of goods sold will clearly entail a lot of high-paying jobs. Or how about Walmart, the nation's largest retailer and largest private employer, which shocked Wall Street by not only announcing its expectation of declining earnings in 2016, but flat revenues as well. Let alone McDonald's, the nation's second largest private employer, which amidst an incredible 3-year run of declining sales, may well be reaching its end of days as a major U.S. corporation, per this quote from one of the leading franchisees last week. Quote, "We are in the throes of a deep depression and nothing is changing. Probably 30% of operators are insolvent, and McDonald's may literally be facing its final days." And then there's IBM, whose fall from grace cannot be more perfectly epitomize all that corporate America is suffering from a lack of innovation to reduced capital spending to the cancerous rechanneling of corporate focus from core businesses to the business of maximizing stock price, and thus executive stock options, by borrowing the Fed's cheap money and using it at the behest of influential activist shareholders to pay dividends, buy back stock, and execute financially debilitating mergers and acquisitions. Which clearly hasn't worked, as what was once the Dow Jones Propaganda Average's largest component has seen its stock plunge by 30% in the past 2.5 years, and this despite unprecedented PPT support of the world's most widely watched stock index. IBM's debt has risen by $8 billion over this ugly period, whilst its debt-to-capitalization ratio has surged from 55% to an extremely dangerous 70%, and its earnings declined by more than 60%. Gee, I wonder how many of its 380,000 employees will be getting the pink slip in 2016, particularly in light of last week's utterly horrifying third-quarter earnings report and a collapsing global economy. And then there's Caterpillar, the world's largest mining and construction equipment manufacturer, which following last month's announcement that it is laying off 10,000 workers, or nearly 10% of its global workforce, earlier this week reported its 34th consecutive month of declining global sales, including 11 consecutive months of double-digit declines, which, by the way, is nearly double the 19 months of declining revenues it experienced during the 2008 to 2009 financial crisis. Which only validates further, in spades, my belief that we are amidst the worst global economy of our lifetimes, particularly because the aforementioned historic worldwide commodity, infrastructure, and government overcapacity will only get far worse before it can even be dreamed of recovering. Emphasizing the point further, even Jim Cramer himself, who, like Louis Prothero in the 1984 must-watch classic movie V for Vendetta, i.e., The Voice of London, is all but paid to put a positive spin on any and all economic data. But 2 years ago, Cramer proclaimed Caterpillar quarterly earnings reports to be, quote, "the only conference call you will ever need, as it is my gospel, my go-to call on which many of my decisions are based on because it is a superb evaluator of what's happening in each of the countries it sells in and gives you the most thorough description of each economy. In a nutshell, Caterpillar is the primer, the source for your global outlook." I guess this quote from his 2013 book is not as damning as his 2008 interview, long before he could have imagined the power of YouTube, in which he brazenly admits to having manipulated stock prices. However, given the far wider ramifications of Caterpillar's impact on the global economy and financial markets, my guess is he'd be equally happy if this quote disappeared as his stock manipulation admission. Or, for that matter, his call that the financial sector was an historic buy at the top in early 2008. Or, better yet, that Bear Stearns is fine on March 11, 2008, and that you'd be silly to sell the stock, then trading at $62 per share, as in the worst-case scenario would be taken over. Well, taken over it certainly was, just 6 days later, by J.P. Morgan with heavy taxpayer-funded guarantees, at drumroll please, $2 a share. And by the way, showing just how hopelessly intertwined today's global political, economic, and financial horrors are, Caterpillar happens to be an Illinois corporation, so most of the layoffs, which I assure you won't be the last, will be in Illinois, which just months after its largest city, sorry Chicago, was downgraded to junk status, announced last week that it couldn't pay its pension fund obligations, as for all intents and purposes, the state had run out of money. Which, as it turns out, is the same plight faced by countless thousands of underfunded pension funds, the result of an inexorably declining global economy, i.e. the worst of our lifetimes, and the repressive, wealth-destroying impact of 7 years of zero, and in Europe's case, negative interest rates, which prevent savers of all ilks from compounding their capital, whilst it is simultaneously eroded by the unrelenting inflation caused by explosive money printing, as history's largest fiat Ponzi scheme races through its final, terminal stage. Of course, Caterpillar and Illinois and the United States and pension funds and municipalities are just the tip of the global iceberg of economic devastation, which ultimately is always funded by the printing press. Heck, just yesterday I read that Obama is issuing a so-called roadmap to Puerto Rican solvency, in which the quasi-U.S. protectorate, just as Fannie Mae was once a quasi-government entity, could have some of its massive $73 billion of debt forgiven if it allows a European-like but U.S. government-operated administration to take it over. In other words, a U.S. government takeover of Puerto Rico, just as Europe's Troika have attempted in Greece, stealing civilians and sovereign governments' money and freedom. We know how such draconian actions are proceeding in Greece, and Brazil, Argentina, Turkey, and Russia, among others. And thus, never before has my belief that revenge of the people referendums, as we just witnessed in Catalonia, Spain, will explode in the coming years. Which I might add, only fuels the downward momentum of economic activity, which in turn spreads its cancerous wings throughout the entire intertwined financial world. And how do the powers that be react to said economic collapse, you ask? In the same manner as always, of course. Not that the majority of listeners don't know this already, by printing more money. To wit, whilst the entire financial world, largely compromised and predominantly ignorant, took the Fed's recovery and imminent rate hike propaganda as gospel, the Miles Franklin blog could not have been more vociferously disagreeing. And thus, seeing this morning's prediction from Citibank of imminent monetary policy easing by the central banks of China, Australia, Japan, and the ECB, and a delayed interest rate liftoff until March 2016 in the United States and the end of 2016 in the UK, cannot have been more validating. Or for that matter, perennial gold hater and cartel collaborator Goldman Sachs' updated expectation that the gold weakness it had anticipated may be pushed out now that it too expects the Fed to maintain zero interest rates until at least 2016. Which is to say, in layman's terms, indefinitely, or in my terms, forever. Which is exactly what happened in Europe this morning, when, mere weeks after Mario Draghi claimed the ECB's historic open-ended QE program, which has already been directly expanded once and indirectly a second time, was generating better-than-expected results. Well, he may be increasing it yet again at its upcoming December meeting. Citing downside risks to both Europe's economic and inflation outlook, he said ECB committees have been tasked with working on instruments to be utilized in further QE expansion, which I might add, he now claims will continue not just until the original September 2016 termination date, but, quote, beyond if needed. Promptly, the euro plunged, as he planned, as the final currency war I warned of nearly 3 years ago thrust forward toward mutual thermonuclear annihilation. Stocks and bonds surged, and even the copper PPT tasked with saving Glencore caught a tailwind, which, like all artificially orchestrated market manipulations these days, will inevitably and likely imminently fail once reality sets in and other central banks respond in kind, such as the aforementioned banks of China, Australia, Japan, and say it ain't so, the U.S., which faces more manufacturing job losses than those four nations combined. Let alone as the collapsing shale oil bubble, now in DEFCON 1 status, now that last year's balance sheet saving hedges have expired, is certain to shed thousands of workers from the only industry that has generated significant labor market growth, other than part-time, minimum wage paying, largely birth-death model created, waiters and bartenders, since the 2008 financial crisis, which in turn will further push the Fed toward its own inevitable monetary epiphany, i.e. the Yellen reversal, when faced by the cumulative smothering weight of collapsing economic activity in financial markets. It must not only admit the recovery is dead, but take the Fed funds rate negative and launch what will be, for all intents and purposes, QE to infinity. Meanwhile, as currencies the world round continue to collapse in serial form, some like the euro and yen by self-immolation, and the majority due to the collateral damage of said currency war and commodity implosion, the so-called powers that be are working harder than ever to support last-to-go stock markets like the Dow Jones propaganda average and suppress the ultimate canaries in the coal mine that gold and silver represent. Regarding the former, just how many dead ringer and Hail Mary algorithms will it take before the entire world realizes stock markets are completely under the control of governments? Or heck, blatantly manipulative statements like those of Chinese Premier Xi Jinping yesterday, who claimed a Chinese hard landing will not be allowed, despite record Chinese capital outflows, its lowest economic growth, LOL, in decades, and a Mount Everest-like dead edifice, the majority of which is held within the unregulated, catastrophically dangerous shadow banking system the PBOC's historically negligent policies have fostered. As for precious metals, even I have been floored by the blatancy and manipulative firepower that have been put into the current cartel attempt to defend gold and silver's respective 200-day moving averages of 1176 and 1597 per ounce respectively, which last week, or this week, were breached to the upside for the first time in 5 months. So much so, I actually wrote 3 straight articles about gold and silver manipulation this week, culminating in yesterday's must-read Precious Metals Manipulation Primer, in which I used the sum total of my 13 and a half years of intensive research on the topic to prove my point, which is that Western central banks, or more aptly put, the governments that control them, are spinning their wheels more than ever in their hopelessly unwinnable battle against the indefatigable forces of physical supply and demand, which, with each passing day of price suppression, are growing exponentially stronger. To wit, yesterday's fantastic article by the great Steve Sanangelo of SRS Rocco Report, showing a graph of Indian silver import demand versus COMEX-created paper silver prices, in which one could see that in 2012, with silver prices at record levels in Indian rupees, India imported just 500 tons of silver. Whereas now that the Indian rupee price silver prices have been smashed by the US-led cartel by 40%, 2015's Indian silver imports are expected to surge to a record 1,700 tons, or 3 times the level of 2012 and nearly twice the amount imported during the 2008 financial crisis. Here in the States, where the record-setting demand bullion dealers like Miles Franklin experienced in the third quarter has somewhat diminished, ironically just after prices started to surge 3 weeks ago, we are still experiencing elevated premiums for popular products like Silver Eagles, Maples, and Junk. Not as high as a few weeks back, when cartel smashes to prices as low as $11.05 per ounce and $14.40 per ounce respectively caused a massive and diverse mobilization of silver buying activity. But still historically elevated, which would tell you just how tight demand is, and more importantly, what it's likely to look like when the next crisis hits and supply dries up more rapidly than in 2008. As I deemed it in an early article this week, a massive precious metals reality put has developed at levels just below the current prices, as not only is the entire world starting to realize the dire economic outlook and monetary policy future, but they are rapidly understanding that the precious metal mining industry cannot survive at such historically suppressed prices. Which is why it's so empowering to realize that buying physical gold and silver at the current prices, you not only have unparalleled monetary fundamentals as a tailwind, but economics 101. To that end, we can only reiterate, as vehemently as possible, that the time is now to protect yourself whilst you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. Consequently, if you are considering the purchase, sale, or storage of precious metals, we simply ask you to give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks, and have a great weekend.